I tried to keep up with what happened a couple of weeks ago on
Yeah.
Wall Street, and I read a very good story in Business Week this week, the most recent Business Week, and I ended up even maybe more confused, but maybe more concerned than I was, because it appears now that they still don't have a handle on what exactly happened.
You know, some of my staff gets upset at me when I say that we probably never find out what happened. And one of the big reasons we'll never find out what happened, if you go back and read the speeches I was given in the fourth quarter of last year, we're not keeping track of what's happening. And one of the biggest things that I've been working on is high-frequency trading, which I started talking about, 8 or 9 months ago, and the fact that, what happened with high-frequency trading is that it's kind of a formula, a bad formula. And the bad formula is wherever you have a lot of money and a lot of change, high-frequency trading now is 70% of the trades are high-frequency trading. Now we're 30% just 4 years ago. And what happened was when we went from kind of floor trading, that we're all familiar with, to the digitalization and industrialization, and then the move to these high-speed computers to make the trades, they just took over the market. And so you got a lot of change, a lot of money, a lot of change, no transparency. We really don't know what's happening in this area because we don't keep track of what's happening. Right now, we don't even keep track of on many times the customer's name or the time of the trade. So we've got this massive amount of don't have transparency. And therefore, if you don't have transparency, you cannot have regulation. So we allowed this to grow up kind of without anybody watching. So now it's just massive, and it's completely unregulated. And so then you have bad things happen. And the reason I use this example is because it's exactly the same formula as what happened in derivatives. In derivatives, we have a lot of money, a lot of change, no transparency. I mean, the Congress was complicit in this, not keeping track of what was going on in the derivatives market, and no regulation. The Securities Exchange Commission didn't regulate. The CFTC, Brooks v. Bourne, the CFTC got in a lot of trouble by saying we've got to regulate these derivatives. And then we had this massive meltdown that just practically destroyed the U.S. financial system, practically destroyed the world financial system, and just left millions of people without jobs, without homes. And so what I don't want to have, people saying, well, why are you so concerned about high-frequency trading? It didn't cause the meltdown 2007, 2008. To some extent, that's true. Although in the summer of 2007, we almost had a massive meltdown because of algorithmic trading and high-frequency trading. So it's not something that has happened. But my point is, you can't just, we got to do something about derivatives. We have to do something about that. But we got to be looking forward to what is the next potential problem. And that's what I think happened on May 6th. What happened on May 6th was, the computers. Something happened with computers. At the same time we're doing this, we did away with the uptick rule. We allowed people to start doing naked short selling. And so some of the things that are at least alleged to have happened, I think it's pretty well been determined at least that it wasn't what we call fat finger. It wasn't somebody, saying billion when they meant million. And when you have Accenture go from $40 a share to 1 cent in almost record time, that means to it's a high-frequency trading computer problem. And that can't happen. And now, on short selling, we have this new rule they came up with, the circuit breaker rule. Okay? So I see this, when you look at May 6th, what I was calling for was tagging, and that is begin to keep track of this. We had to report who your customer was, what time the trades took place, more information for things which we're not doing. It's hard to figure out how you can go back and kind of sift through all this data, having not kept track of it while it's happening. Right? So that's a long explanation. I mean, I just think we got to the point where on May 6th we just kind of said, okay, guys, we just can't worry about what happened in 2007. Right. What happened? What's the next area?
Isn't the other issue here, obviously, the Greek debt situation was was propelling the nervousness that led to people doing this stuff.
Sure.
Is this system capable of handling a much bigger crisis?
Well, that's, this is a much, here, my concern is that everyone says, we have those 4 days of hearings of the permanent subcommittee on investigations. I don't know if you saw any of that, but Goldman Sachs got the big part of it. But really, the big part, we did Washington Mutual, which is a bank, $400 billion that failed. You listen to what they had to say about why it failed. Then we had the regulators who were supposed to be watching Washington Mutual. And then we had the rating agencies who were supposed to be doing rating. Washington Mutual, 90% of their home equity loans were stated income loans. They call liar loans. Yep. That's a systemic breakdown. That as one regulator said, that's a target-rich environment for fraud. We have regulatory agencies who are rating thousands of bonds during this period, thousands of these securities as AAA, and half of them during 2007, 2008, all of which became junk. So you got to wonder, how do you rate AAA and just, shortly afterwards it becomes junk. And then we had Goldman Sachs, who essentially said, it is legal. It is legal for them as a market maker to be selling you a residential mortgage-backed security in the form of a credit default obligation. Sell it to you, at the same time go over and bet that it's going to fail. They can do that. It's totally, nobody else, I don't know any of the other businesses you can do that. You cannot disclose to you, say, hey, by the way, I'm selling you this, but I'm also selling it, I'm trying to bet that it'll fail over here.
Isn't there some indication the banks are doing that on municipal bonds or something?
Oh yeah, no, everybody's doing it now. As long as you claim you're a market maker, you can do that. That's one of the things I wanted to have in the financial regulatory reform bill is this conflict of interest that, to deal with this conflict of interest that you can deal with now in the law, where you can be a market maker and basically sell something to someone that you, at the same time you bet it's going to fail. So what people say is, but when you talk to them, you talk to the Washington Mutual people, you talk to the Goldman Sachs people, you talk to the rating agencies, you talk to them, they all say the same thing, is that we have this incredible natural disaster, City Center. What you got to know is we have this natural disaster that hit us. It's kind of like a hurricane or a typhoon, and it was the housing market. And the housing market crashed, and we were caught holding back as this natural disaster. And I'm saying, it doesn't sound like a natural disaster to me. It was something that was endemic into the system, where we had mortgage brokers out there selling these liar loans and state income loans, packaging them up. Wall Street came in with a vacuum cleaner, sucked all these things up, didn't really care what the quality was because the rating agency was going to give them AAA rating. Then they sold them to people at the same time as selling them short over here. That doesn't sound like a natural disaster to me. That sounds like a totally man-made disaster.